Morning, everyone. Let me just pull up and before I dive into the detail, the short answer is all of the above, depending which city, district, or project you look into. And what I will run through is our latest thinking about the situation, about where we are in the cycle in the housing market, inventory situation, some of the topical questions about the bank debt, household leveraging, another issue we know people are concerned about. But just before we dive into those details, I wanted to, if you are looking at China in general, this is nothing to do with property market, but there's this very interesting piece of work done by the groups of US and Chinese think tanks, academics, and smart folks who figure out a number of alternative scenarios for China for the next 15 years that you can see now on screen, muddling through Asian power fragmentation, shutting the doors, global powerhouse, and it's a fascinating set of scenarios to think about for the next 15 years, with a major twist, and that's the only reason I show that this was done over 20 years ago. And when you think about that mindset from 20 years ago, you could apply the same scenarios would probably still hold today. And when we think about China residential, China housing market, one of the things or feelings I have by looking at it in depth on the data front is that the story keeps repeating itself and going on, and every time it feels different, but actually the patterns have been the same for several cycles, and that is one of the themes of one of our thesis about the market. So to immerse ourselves into the dynamics of the housing market, and also to clarify that when I say housing, I do mean the market for new home sales. So when a developer buys the land use rights, starts construction, pre-sales, sells everything, builds, completes, moves on to the next project. So for that part of the market, that will be my focus here. And to see the dynamics of what's been happening in this market over the past 6 years, have a look at this chart on screen. In a second, I'll show you how this chart changed on a monthly basis over the past 6 years in a dynamic, sort of fun way. But let me explain. This chart shows the year-on-year change in average house prices for each of the major 100 cities across China. So the bigger the bubble, and the green the bubble means large green is very strong positive growth, large red is very strong negative growth, and then things in between. Let me walk you through how this picture evolved over the past 6 years or so. So if we start back in mid-2011, everything was green. It was the post-stimulus boom, but after restrictions towards mid-2012, we had more of a downturn scenario. There was interest rates cuts, some new stimulus measures, but it took time to take effect, and only by beginning 2013, you started seeing the next cycle and the booming, everything bubbling up, very greenish, across the whole map. And that lasted until mid-early 2014, when post-tightening measures, again with a lag, everything started going down. And then when things turned red, this cycle lasted until Q2 2015, when things started turning back again into positive. However, now observe how different it is in the current cycle as we are getting towards June 2016 again, how these bubbles are more unevenly distributed. So there are many more reds and many more greens at the same time, and some select cities are particularly strongly green, whereas some others are still quite red, which is different from the previous cycle. So it's a very interesting way to look at it, because it helps explain some of the key dynamics in the housing market. The other way to look at it is same data presented on a heat map over time, where each little row is one city of those 100 cities. Each tiny little column is 1 month of data. And the greener the color, the higher average house price for that one given city, right? So it also shows you in a more static way how everything being cyclical, but the picture is much more colorful in the last cycle. Interestingly, tier 1 cities here at the top, they tended to be more greenish, although not all of them. Some of them were turning yellow recently, so turning more negative. But at the same time, it's not just tier 1 cities. Some of the best performers actually have been lower tier cities that you could describe as spillover cities nearby other major cities, like Kunshan near Shanghai, Zhongshan or Huizhou near Shenzhen and Guangzhou, Baoding near or Langfang near Beijing. So actually some of the best opportunities for local developers, if they could access them, were in those spillover cities that were benefiting from tier 1 cities. And then the question, one of the bigger questions is what are the key drivers of this housing market and those cycles? So first and foremost, you could really correlate the dynamics to tightening and easing of the monetary policy with a very clear around 6 month lag or lead, depends how you look at it. One of the best indicators at the macro level is M2 money supply growth. And you could see that very clear pattern happening since even 2006, tightening, easing, and the house prices behave accordingly with a lag. However, there is also the housing policy dynamics, which tend to happen around the same time as monetary policy, and typically this is the imposition or removal of home purchase restrictions of various sorts, plus either some local stimulus measures to support property, or to in fact restrict activity. It could range from taxes to outright price limits, and those factors have been really the fundamental drivers of those cycles. But the other theme around the divergence of performance is something new. Because you could say markets have always been divergent, right? It's always been true. But as you've seen on those visuals, it's much more pronounced now. And I would argue it is a function of the economy becoming more differentiated, even all the way down to specific companies and the extent of the success of the local corporate environment that creates employment in a particular district or area, and how it drives the housing market. That's becoming more pronounced. So you would have the areas of very bad situation, like in some parts of the Northeast, and you would have the boom towns around Shenzhen and the high tech space. So they'll be highly differentiated because of the underlying sectors. What is also quite new in the current cycle and in the most recent couple of months is how differentiated the housing policy is becoming at a city level. So previously you could argue that these things moved in sync. There was either tightening or easing, monetary and housing. And now what you see is that some cities are tightening the policy. For example, Shenzhen, Shanghai, but also lower tier cities like tier 2 cities, not only like Nanjing or Hefei, where you've seen quite significant surge in prices and land prices. They are tightening the policy, but at the same time, almost through announcements on the same weekend, the cities like Ningbo or Shenyang or Zhuhai, they've actually been easing the policy. And in addition to that, over the past months, what we've seen is more announcements about specific implementation measures of the so-called supply-side reforms across the country. So the general guidance is about reduction of capacity in oversupplied industries, probably more geared towards mining in those sectors. But in property, in practice, this means that at the same time, the local governments try to encourage more buyers from the rural areas to buy in cities. That's one major theme that we see consistently across. But at the same time, they are restricting land supply in many cities where they consider locally that there is oversupply. And in many cases, they also are more liberal about repurposing the land use rights. So if it was supposed to be a resi project and the land stays empty, they may repurpose it for something else. And this is how they deal with those oversupply situations. We also have seen, like on the ground, some real cases where even the local government would purchase a portion of a commercial residential project instead of constructing a new one, instead of creating new supply. So this is what we see either through data or through talking to people and our experience on specific projects. The question then obviously is, so what does it mean in terms of outlook for that cycle in the market? And here, let me show you just briefly a little bit of history. The green line that you see on this picture is a measure of house prices across 100 cities. And it shows a year-on-year change up until January 2014, when we started looking at the forecast around this market. And just for a quick reference, we then said this was what would happen in 2014, and this is what actually happened. So it seems that we got it quite right, unusually in that year. Then in 2015, we expected that rebound, and in reality, even stronger rebound happened, but following the similar pattern. But also it means that there may be something to the methods and calculations we actually use to derive that. And when we apply the same logic and reasoning going forward, let me show you our forecast for the next couple of months. We believe we're actually right at the cusp of a turning point again in this cycle. And we see a number of indicators that would suggest that the change is quite immediate. Now, remember, we're talking first on this green line in terms of year-on-year house price change. So we would expect that naturally first to just slow down and not necessarily turn negative on that measure. Our main scenario is that right about this or next month, we'll see the reversal of trend, and then gradually coming down towards the end of the year. But we also assign some probability to sort of a repeat of the 2013 pattern, the scenario we call S2 on this picture. And what are the main drivers behind that, or what's the reasoning behind this? Number of factors, but the main component is the dynamics of the sales volume growth, which now show quite a significant adjustment, although still it's not the downturn, it's a slowdown. The red line that you see here captures the sales volume growth in gross floor area terms, and you can see that after a big run up in Q1, it started coming down, but the prices still kept accelerating. And to us, that's one of the key signs. But more importantly, when you look at those index measures, a number of major cities that drove up the prices on average, like Shenzhen, for individual cities like Shenzhen, we actually see very clear signs of impending correction, namely a significant drop in volumes. So if you look at, we don't have it on the chart here, but if you looked at 3 months year-on-year and 3 months sequential volume change in Shenzhen, it would be one of the worst performers among 50, 60 major cities over the last 3 months. And usually the volume growth precedes the price growth dynamics in our experience. So that's why we believe the impending point is quite immediate. One of the big questions that's always there is like, who's buying those properties? Where does the demand come from? And I think when you think about the demand for housing, it's worth breaking that into a number of components. I would present it this way: local upgraders, people who sort of middle-aged, they have a family, they got more money, they see housing as a major dimension of quality of life. They just want a bigger one, better one, across the river where it's less polluted, all kinds of reasons, and it's not their first home. Local first-timers, usually related to marriages. By the way, there are around 12 million marriages per annum in China. Migrants, not necessarily the low-income migrants, but people who, for instance, go to major cities to study there and they want to stay and they would want to buy a property once they get good jobs. Investor speculators, still a group, although from what we understand, it's actually not such a significant group at all today. Rural to urban migrants, so that group that is being encouraged by the government as the one that create that sort of new demand to structurally move to cities. And the value storers, so a more, not necessarily the notion of investors who believe that they don't actually believe that they would significantly grow the capital base by investing in property. They simply want to keep it as a relatively stable store of value. That's the assumption they take. So if you look across those groups, the local upgraders, in our view, is the most significant component of the demand in practice. If you look at the mass market residential, but it would vary by cities significantly depending on local dynamics. One of the other important considerations when looking at China housing market is to recognize the role how the national figures square up with the different categories of cities. So it's interesting to see that tier 1 cities, so Beijing, Shanghai, Shenzhen, Guangzhou, as per city, they disproportionately have higher per city share of the total, but as a group, they're actually very tiny share of the total market. In this chart, you see the national sales, new home sales, gross floor area, and how different tier cities make up that set. So the conclusion from that is that if you're a property investor, if you look at companies investing in specific tiers, the macro data of that nature becomes less relevant because those tiers are very, very tiny portion of the total. But equally, one cannot really scale up the conclusions from tier 1 and tier 2 to the macro view on demand for cement, commodities, and so forth, as there is this huge bucket of 44% of sales in GFA terms that are very hard to understand because there's really no good data on those individual cities. You only get that by comparing to the ones you know, and those you know are typically quite well performing. So that takes us to another big question about oversupply. And this question obviously has been debated for a long time in many ways. So here's our take on that. Some of the key figures to look at with regard to oversupply at macro level is the annual sales here of commodity residential housing of around 1 billion square meters per annum for the last few years against the under construction area. But more importantly, and this is just our estimate of a true inventory, which is the portion of the under construction that hasn't been sold yet, as most of the sales in China would be pre-sales, right? So you sell the uncompleted properties. But then you have to make some other adjustment of those that are completed and not sold, historical inventory, and so forth. So, but whether you measure it one way or the other, you do come up with a clearing period of anywhere between 2, 3, or even more years in aggregate, and that's often the figure that raises the concerns when we discuss the oversupply. However, here's an interesting macro dynamics around that. First, already on this earlier picture, you saw that the under construction area for the first time in 2015 actually saw a year-on-year decline, and on a year-to-date basis 2016, we see much further decline in that figure. then sales volumes in 2016 on January-June year-to-date basis actually have been at the record high by any standard in history. While at the same time, new starts that did pick up, they haven't picked up so strongly. And the land sales that represent the indication of the future supply remain really, really low. Now, land sales is partly a function of the policy, of the land prices, various factors. But the fact remains that that indication of future supply is low. Now, the question that often then comes up is, but that figure, if I go back to that figure of under construction, it doesn't capture the potential future supply that is not yet under construction, but is sitting there in the land banks. But then you could make equally the case that there is a portion of the under construction area that we call sort of the dead supply or irrelevant supply that would never really fully materialize or would fail. So it's hard to judge exactly, but I would say at the macro level, the static picture looks more of a concern, but the dynamic picture of what's been happening over the last 2 years actually says there's not such a big problem at all in that domain. And if you look at the major 13 cities, with a caveat I mentioned earlier about what portion of the total they make, actually the pace of inventory clearing in those 13 major cities is the best ever. They really clear inventory very quickly. It's the yellowish orangey line at the bottom. And by inventory clearing here, I mean months to clear, how many months it would take to clear inventory if we assume a 6 or 3 months average pace of sales would continue at the current level. And that then brings us to the question, so what about those new starts? I understand that there's a lot of interest in China properly purely from a point of view of demand for commodities or related services. And here's our take on a best guess on what would happen to new starts, the red line that you can see here. And the reasoning behind that, those next 5 years, is that new starts tend to follow historically quite nicely the dynamics of sales volume growth and price growth with a bit of a lag. So that's why we would argue 2016, this forecast actually from a few months ago, why 2016 would be positive, even though we would expect a cyclical downturn, but the momentum for the new starts would still continue into the next year with a lag. But following that, we would see the reversal. And then after another cycle that we would expect to see, would see a similar pattern. That's the best guess. Obviously, this could be a big discussion for a whole separate session, but we wouldn't expect a really major, very significant either drop or pickup in new starts on that basis. The other big question that then emerges is that of a debt. So on Malcolm's China debate, you had fantastic talk the other time about the debt situation in China. So I wouldn't sort of repeat any of the points, but there is a very interesting twist, or 2 or 3 twists I would try to demonstrate here. First, there is this notion of corporate. The problem is with the corporates in China, right? So households are not so leveraged, central government is not so leveraged, the corporates are hugely leveraged. And IMF did a study not long ago, so this is our repackaging of that in a slightly different view, where they look at listed companies. But many people don't go that deep to look at the breakdown by sector. And I think what is interesting here is that it shows that when you look on the left-hand side, that real estate is does have very low as a sector interest coverage ratio indeed. However, if you look at the dynamics of that over time, it actually got less worse than the other sector. So everybody worsened, but real estate actually didn't worsen that much as the other sectors like mining, for example, who are highly leveraged, and situation worsened over the last 5 years. So when we talk about the divergence of property markets, it's also worth keeping in mind the divergence of sectors when you bring up any of those macro debt issues. And then what it doesn't, on the other hand, take into account is that obviously a lot of the financing dynamics may not be captured through interest expense and maybe other structures of balance sheet structures that may cause issues. So there are lots of other twists to that, but nevertheless worth thinking about. The question of where the lending, the money goes from banks is another interesting one. We look at this data, not sure if you're all familiar with this, that the developers in China have to report their sources of funds. And it's kind of a funny calculation. So this data shows how much of the sources of funds for developers for January-June period this year comes from mortgage loans. It's essentially like the measure of how much of the revenue they get from selling those units is funded by mortgages. And it shows quite strong growth, very strong growth, about 50%, much stronger growth than the sales volume growth. It's more like 20-30%. So that indicates, there's one indicator that is the households that are getting more leveraged, that they are taking more mortgage debt relative to adjusted for the general growth in volume. And that would make sense because you would think about it that they actually starting with a relatively low level of leverage and debt in the first place. However, when you look at the other category of sources of funds from domestic loans, they've barely increased for the same period for the same developers. Now, this can also relate to the fact that banks are less willing to lend. The significance of other sources of funding is more relevant. But in terms of pure bank lending, certainly it hasn't gone up in line with what you would see in terms of activity in mortgage lending. So that's another interesting consideration. And the most fundamentally, in terms of the dynamics of competition among developers, one of the things we see, and this is also from first-hand experience on the project, is I would say it's all about the product. So historically, the competition was very much about the right piece of land, and just if you had the right piece of land, it would just sell anyway. It didn't matter what you did with that. But in the market that is now much more mature, it's quite richly supplied overall, with much stronger competition and still so many developers, it really matters whether the developer comes up with the right product or product mix. So you could be in a very oversupplied market, and we've seen cases like this, where you would think there's nothing to be done there, but if you come up with the right height of the building, because in higher floor buildings, elevators don't work in winter, so people don't want to move to such buildings. So now everybody wants lower-rise buildings. Or if, given the financial constraints, the families want a 3-bedroom apartment, but it needs to be limited to smaller square foot or square meter size than normal, because only then they can afford the absolute amount. All those little details now become critical in ability to sell property. And one of the drivers of that is simply the fact that the upgrade demand is now much more significant than the other sources of demand. And upgraders, they are much more discerning. They know the market. They have experience with the property market. And that's the group that on one hand creates opportunities for more entrepreneurial and very targeted developers, but it also creates more challenges for the overall oversupply component in those markets that are oversupplied. And we could chat about this in in more depth there is time. So in my sort of rundown here, I would summarize that the way we look at the market is there are clear policy cycles are the big drivers of these sinusoidal house price dynamics, and we are now, we believe, at an impending point on the way down, although that hasn't yet started, largely because the volumes indicate that. Divergence is much more pronounced now than before, whether you look at house prices, volumes policy, localized policy and application of supply side reforms. Oversupply issue, I would say, is being handled. It's actually not an issue in itself relative to where we were before. But that remains a big question for debate. And household leveraging up is growing potential concern, although probably not yet, given the absolute low level. And the point about the product, that's really becoming the nature of the competition.